Hello and welcome to SwitzerTV Property. I'm Peter Switzer, and this week we blow the property doomsday predators out of the water with the guy who relaxes by flying his drone to catch out sharks preying on New South Wales swimmers on beaches up and down the coastline. Joye of IAMP Capital. And Chris tips house prices are more likely to rise than fall, and given he's been the best predictor of coronavirus infections and deaths here in Australia and across the world, he's a guy you ignore at your hip pocket peril. And then we have the economist's view on how deeply our economy will fall and then rebound, and then how that will hit and hurt the property sector now and into the spring sales. We do that with IAMP Capital's Diana Musina. And then we see what it's like being a valuer who has to guess what's happening to home values for home buyers, buyers agents and lenders when you can't even enter the property. And we do that with Tony Mangione of Mangione Property Valuations and Consultancy. So let's kick off and catch up with the very controversial Chris Joye. Well, at this point in time, with the coronavirus clearly unsettling the economy, there are people out there making predictions that house prices could fall by as much as 40%. And of course, the doomsday merchants who always want to believe that house prices will fall by that amount have been jumping on board, giving themselves a good pat on the back for correctly predicting it, despite the fact they've only been helped by a potential pandemic. But Chris Joye, the person who loves fighting doomsday merchants, says forget about 40% house price falls. Chris Joye from IAMP Capital, thanks for joining us on the program.
Thank you for having me, Peter.
All right, now Chris, let's just kick off. You wrote a story in the AFR where you basically poo-pooed the idea that this coronavirus will create massive house price falls. Give us the guts of your argument.
Yeah, so we forecast in March that the peak in new infections would come much earlier than people had anticipated. The epidemiologists were talking about peaks in June, July. The Prime Minister, Peter, was talking about having to put the country in a 6-month business hibernation, which would have been depressionary. And on that basis, the RBA is talking about the biggest economic contraction in about 100 years. So that does look very grim for house prices. But as I mentioned, we have built very sophisticated COVID-19 forecasting models, and in March published an academic research paper basically projecting that the peak in US, European and Australian infections would be early April. And that's what we've seen. We've seen curves flatten quite dramatically around the world. And this now gives an important corollary, and that is the opportunity to exit containment much earlier than the PM and policymakers thought. Yep. So we've proposed also in March that the PM exit containment after 1 to 2 months. Initially, I think he was not partial to that view based on conversations with the government at the time, but he hasn't referred to the 6-month business hibernation in 3 or 4 weeks. And he's now actively talking about exiting containment early in the next 3 weeks. Now, this is very important for the housing market, because what is actually interesting is we have seen ongoing, as we expected, resilience in the housing market. I'm just going to show you a few screens. So I'll share some screens right now, mate.
Yep.
So the first screen that I'm going to share is Sydney house prices. So this is the CoreLogic index. I'll actually just I'll hit max here.
Yeah.
And so basically this is the boom from 2012 to 2017. This is the correction in house prices. We called that boom in 2017. We said there'd be a 10% bust, and that's what we got. And in April 19 last year, I said the bust, this is about here when prices were still falling. I said the bust is over and we're going to get a 10% bounce in prices, which is what we got. But you can see that house prices, if I go over the last 3 months, the last 6 months, you can see that house prices in Sydney, mate, continued rising over February, March, and only in April have we started to see them very modestly flatline. Now, this is a daily index. It's probably it is the most advanced daily index in the world. Now, if I switch to another screen, which is our Melbourne house price screen here, you can see a somewhat similar story. So prices start rising, in mid-2019. You get a circa 10% increase in capital gains, and they continued increasing in Melbourne over February, March, and we've just started to see them flatline over April. Finally, I might just quickly have a look at Brisbane prices. So again, I'll just share one more screen. So this is Brisbane prices here, and same story, flatline in mid-2019, a strong recovery, but we've seen Brisbane prices increase over February, March and April. Now, here are the key points, Peter, that if we're right and the number of new infections in key developed economies peaked in early April, and if we're right that the PM can junk his 6-month business hibernation plan and actually exit containment rapidly over May, what that means is we can transition to a new normal much more quickly than people anticipate, and we can revitalise economic growth more rapidly than was otherwise thought.
And Chris, can I just throw this one in as well? If that's the case, is there scope for the government to reduce the promised spending that they thought was going to be necessary over the 6-month program, or will there be a lot of just promised spending that will actually happen, which could actually fire up the economy so strongly into 2021?
Yeah, so that's an excellent question, and this is something I've actually been writing about in the AFR for some time, Peter. And let me just firstly say that Prime Minister Scott Morrison has done a magnificent job with the state governments in managing Australia's containment approach, which has been basically the most successful in the world other than Hong Kong and New Zealand. Secondly, I think when they announced this massive mother of all fiscal policy packages, at that time, the epidemiologists, the best medical advice in the world was going to be that we would have shut down, we would have a lockdown for 6 months, and we would have this depressionary economic result, double-digit unemployment and so on, which would have been an absolute economic catastrophe. In fact, I think the health, social and human costs of a depression would have been worse than the virus itself. But if we're right and infection rates have peaked early, if we're right there's not going to be any massive second wave, if we're right the R0 or the reproduction rate of the virus is now well below 1, and we have a decent chance of eliminating it whilst we keep the borders closed, then we can come out of containment quickly. And then the corollary of that is this profound point you've made, because the PM, with the information available to him at that time, made the decision to unveil this huge fiscal stimulus that is actually the most aggressive or generous in the world on expenditure and revenue terms, which was sized for this catastrophe. But if the catastrophe turns out that it's not going to materialise, then absolutely you would think that JobKeeper would be reviewed in 3 months. There is a pre-provision in JobKeeper to review it after the first 3 months. And I can see a still incredibly generous fiscal stimulus remaining in place, but one that is recalibrated and more appropriately sized for the current crisis. But just coming back to house prices, first point is that again, house prices have continued to rise in Sydney and Brisbane through April, and there's no evidence yet of any housing catastrophe. Auction clearance rates have plummeted, but that's because regulations prevent people from actually holding auctions physically. And what we have seen is a big voluntary withdrawal in the number of properties that are being listed. There is no sign as yet of any forced selling, which is what I think would have to be a precondition for a very aggressive drawdown in house prices. Much of the unemployment has been concentrated amongst renters, and the banks crucially have offered between 5 and 10% of all their resi mortgage borrowers this very generous 6-month repayment holiday. That repayment holiday won't show up in their arrears statistics, so they've done a deal with APRA. where they won't have to hold more capital against those loans. It's more of a national holiday, much like the one we're experiencing right now. And so I think there's every prospect that if we can come out of containment over May and June, sort of converge towards the new normal, it won't be the same as what we experienced beforehand. We won't be traveling overseas yet. There'll be some zombie businesses that are permanently destroyed, like Virgin Airlines. There will be, I think, structurally higher unemployment. So I would expect the unemployment rate to normalise around 6 or 7% over the next 6 to 12 months. And conditions will be softer. But I think that the housing market is likely to experience a period over the next 6 months of softness. So I think house prices will likely flatline or at worst fall by up to 5%. And I completely disagree with this idea that house prices are going to fall 10, 20, 30, 40%. It is possible. There's many known unknowns and unknown unknowns. We need to understand whether we are going to get a vaccine, whether we can build herd immunity or immunity generally, like can we develop antibodies that fight the virus. We need to know whether we can get antiviral drugs that will kill the virus. But I'm quietly confident. As one example, mate, everyone's worried about travel and tourism, but more Australians head overseas each year than those that travel to Australia. And I think there will be a very substantial substitution towards domestic tourism because we won't be able to leave our borders. And we will have a more or less semi-unprecedented set of fiscal and monetary policy settings that will provide tremendous support. And that's another key point vis-a-vis housing. We've had mortgage rate reductions. You can get 2% loan rates. The Aussie housing market is uniquely very interest rate elastic. About 80% of all borrowers have a variable rate loan, and those that are on fixed rates have very short-term fixed rate loans. In the US economy, most people have a 30-year fixed rate loan. And what that means is that the RBA cash rate cuts, reducing the cash rate from 1.5% to 0.25% today over the last 12 months has furnished about 75 to 150 basis points of mortgage rate cuts over the last year. And I think house prices this cycle will increase by 20 to 30% nationally. We've had 11 percentage points of capital gains so far. So I think that once we get through this air pocket in growth over the next circa 6 to 9 months, I think that the boom will continue and we will get another 10 to 20% of capital gains to complete this cycle.
And how long will the cycle last for, Chris?
Well, it could last for a very long time, and we saw the last cycle lasted on, over the course of 2012 through to 2017, and we do have these ultra stimulatory monetary and fiscal policy settings that are going to encourage credit creation. I mean, the banks are being actively told to aggressively lend to households and businesses. The banks, through the new term funding facility via the RBA, this is a brand new facility, it never existed before. And the RBA will provide the banks a minimum of $90 billion of funding at a cost of just 0.25%. And it's 3-year or term funding. So it's long-term funding for the banks, which means that they can take this ultra cheap money and support businesses through loans, households through loans. So I'm actually relatively sanguine that the actual economic damage and the downturn won't be nearly as bad as people fear. And I think housing vis-a-vis or relative to all other asset classes has fared exceptionally well. So, if I just quickly flick back to one of these charts. So if you look at Brisbane resi property, I mean, all the way through this volatility, February, prices are higher. March, prices are higher. April, prices are higher. And if I just go to RP Data Sydney here and recut that for our viewers today, and I hit GP on my Bloomberg terminal, thank you, Bloomberg, you'll see the same thing. In Sydney, over February, so Aussie shares fell 8% in February, yet Sydney prices were up. In March, Aussie shares fell 21%, Sydney prices were up. Super was getting smoked. Private equity was getting smoked. The listed investment trusts on the ASX, the LICs and LITs, the high yield bond funds were getting smoked, down 20, 30, 40%. everything was getting smoked, but Resi was the one redoubt, the one safe harbour, rightly or wrongly. It's not that I necessarily want massive QE and ultra low rates. In the past, I've argued against it, Peter. I will just stop this screen sharing to ensure that you can see my my aesthetically appealing visage.
Okay, look. There's the one big problem with Zoom and Skype and all that sort of stuff. I can't shut you up as easily. And Chris, I could listen to you all day, and for a moment there, I thought I was going to have to. But but there are a couple of good questions I know my viewers would love me to ask. Before you came on the scene, the one-time professor of econometrics at University of New South Wales, Ron Bewley, and Ron used to be a star on my TV show, you might recall. Ron once said to me, one of the best financial market econometricians is a guy called Michael Knox, who's the chief economist at Morgan's. And I was interviewing Michael last week, and he said that there's a very good chance that we might see a roaring 20s of the 21st century when we get out of all of this. What's your view on that, Chris?
Yeah, so that's interesting. So in late February, I wrote to the Prime Minister, the RBA Governor and Deputy Governor, Wayne Byers at APRA, and Treasurer Frydenberg, and I said that I thought that markets would not be able to price a global pandemic. And when you have these extreme information asymmetries, you see often market failures and a complete evaporation of liquidity. And I warned them repeatedly over and over again that this is what we thought would come. But crucially, to cauterize that preemptively, we argued policymakers needed to unleash unconditional and unrestricted QE, so asset purchases and fiscal policy support, and obviously liquidity support. They were about 3 to 5 weeks too late. So we got that QE and liquidity support at the very back end of March. It took the RBA 19 days to get their head around the crisis. And obviously we experienced unprecedented falls in the prices of certain assets. But I think that at the end of the day, coming back to my original point regarding the current calibration and size of fiscal policy, there is every possibility that we do end up with a speculative melt up. And certainly in my portfolios, we're 100% focused on assets that are likely to benefit from QE. We own no corporate bonds. We own no high yield bonds. We only own bonds issued by government guaranteed banks. And in our portfolios, we've had our strongest returns ever in history since basically the second half of March through April. We did see the best buying opportunities in history. I sold $422 million worth of bonds in January, Peter, net sold. And I net bought $900 million worth of bonds over late February and through the course of March. So when everyone was rushing for the exits and selling relentlessly, we were buying. And we've now started taking profits in April. But the Morgan's gentleman that you referred to, I don't know him. I've never sparred with him. So he's obviously not in the first grade of the economics community. No, I'm joking.
I'm not going to call you a wanker because you're such a good mate, but that's anyway, you are.
But I will say he does.
Cut to the chase.
He does work for Morgan's, and Morgan's is a stockbroker. So I have no doubt that he's kind of spinning a positive line for stocks. But I think we were absolutely emphatically of the view that there were once in a lifetime buying opportunities in financial credit markets in March. So let's talk about bank hybrids.
And by the way, you did say that, and I actually did use it in a presentation in early March, that if your predictions were right, that we get through this quicker than people expected, it was going to create the buying opportunity of a lifetime. So I will actually say you got that definitely right. But go on.
So it doesn't matter where we look across the capital stack, but if you look at the major bank senior bonds in the GFC, the credit spread, which is basically the compensation that people get for lending to, say, CBA for a 5-year bond above the cash rate, that credit spread blew out in the GFC to about 200 basis points over bank bills, and it blew out similarly in March. Major bank subordinated bond spreads, which were trading at 160 over bank bills in January, blew out to 400 over bank bills in March. And hybrid spreads blew out from 260 over bank bills to 840 over bank bills in March. In the GFC, 5-year major bank hybrid spreads only got to 590 over. So you got to 840 over in March 2020, but in March 2008, they only got to 590 over, despite the fact that the four major banks have halved their risk-weighted leverage on their balance sheets. So there were tremendous opportunities. I remain very positive about financial credit. I think equity beta will do well when we go through the second regime change that we've hypothesized. So the first regime change we focused on was our predicted peak in infections in early April. The second regime change that I think is important for equity investors as well is countries moving very quickly out of containment. I think, Peter, when markets see countries around the world normalizing economic activity, you're going to get a strong rally in equity beta or equity indices. Having said that, there's going to be tremendous heterogeneity because I think the mid-market is going to suffer from lots of business failures, defaults, downgrades in credit ratings, and I think you'll see mid-market and high-yield lenders really suffer from a lot of distress. Likewise, I think you'll see tremendous earnings volatility. So I'm sure within equities, as there is within bond markets, there will be considerable opportunity, but it is complex. And I'm not here saying that we're about to embark on the mother of all economic booms. I don't agree with that at all. We have outlined what we call a V-shaped recovery, which is basically an initial sugar hit as people get back to work and, for example, the payrolls data suddenly improves sharply. But I think thereafter, businesses are going to be left with more debt, households are going to have more debt, governments are going to have more debt. And so I think the growth profile is going to be a fairly subdued one, Peter. So,
okay, you're saying it's not a V-shape or a U-shape, it's a V-shape recovery.
Yeah, so basically the idea is an initial bounce up, but then thereafter it's a more gradual U-shaped recovery. So that's our patented or trademarked V-shaped recovery.
Which I will steal, and it's not trademarked at all. You're carrying on. That's a very good. It's a very good thing for me to steal. Now let's just wrap this up then. For people I want to hear for another hour and a half, mate. Yeah, no. One day I'll give you a solid hour. But let's just wrap this up, mate, because particularly when you started talking about bond yields and stuff like that, you could have sent people to sleep. You understand it, most people don't. But let's just sum this up then, Chris. Looking at the rest of this year, you're expecting house prices to recover. You're expecting the stock market to do okay. Some parts of the market will do very, very well. Other parts of the market will struggle because of the backwash from all this closures of the economy. But let's roll into 2021 and 2022. Are you expecting optimism to prevail or pessimism?
Well, I think in the over the next 3, 6, 9, 12, and let's say 18, possibly 24 months, I think that there is going to be so much fiscal and monetary policy stimulus left in the global economy. We've got record low rates. The central banks are not going to stop buying their government bonds and corporate bonds because the minute they do, interest rates are going to jack back up, and that's going to immediately trigger a great deal of distress. So I think the portents are promising. There's certainly grounds for a lot of optimism. Yeah. There are, I think, fat tails. There are big risks. I mean, one of the things that worries me is what does China's role in the world look like as we come out of this? How much retribution will folks seek and reparations will they seek for the almost priceless human and economic costs that have been inflicted on the world by this crisis, wittingly or unwittingly? And I worry about miscalculations. I mean, Trump's an immensely capricious and mercurial character who's very unpredictable. Xi has, I think, managed his global relations very poorly ever since he came to power and has escalated tensions with Japan, India, the US, Australia. And COVID-19, I think, has really coalesced a coalition of the willing between Europe and North America and like-minded states in Asia in respect of taking a new look at their relationship with China and looking at China through a different lens. I don't think China's now regarded as being a benevolent and benign actor who's going to buy into the Western liberal democratic open trading system. And I think that you're going to see a significant effort, as we saw during the trade war, to decouple from China. Now, that could be also, interestingly, positive for growth. I think you'll see a lot of insourcing globally as people decouple supply chains, and that will stimulate local activity. It will be inflationary. It may not be the economically most efficient set of arrangements, but in the short to medium term, that could be fine. But I'm very positive about the next 3 to 6 months. I've got to say, looking beyond that horizon, Peter, I'm more cautious. I'm just worried about. I mean, think about 2020 so far. We woke up and we had the Iranians send 22 ballistic missiles that they launched at 2 US bases in Iraq. We then had, Australia on fire for much of the month. We've had Resident Evil 4 in the form of the first global pandemic in 100 years. And we now have a sort of reordering of global geopolitical relations with potentially sort of unanticipated consequences. Could Wuhan be the Franz Ferdinand of, the next major power global conflict? I don't know, but it does worry me.
Okay, mate. Well, fantastic. As always, very insightful. And we have to say that your strike rate in 2020, as you would say for every year, has been very, very good. Thanks for coming on the program.
I appreciate the time, Peter. I really do.
Well, one thing we try to do in this property show of the Switzer organisation is to try and work out what is going on in the property sector. Now, of course, a key driver of the property sector is going to be the economy. And so we're talking to the senior economist at IAMP Capital, Deanna Musina. Thanks for coming on the program, Deanna.
Thanks for having me on, Peter.
I feel really bad, I feel unusual calling you Deanna after calling you Diana for all these years, but I'm glad you've corrected me.
Finally, yes.
Well, I've got an Italian auntie. I shouldn't have got that one wrong, but anyway, I did. So, Deanna, let's just look at what you're seeing right now. We've talked to valuers. We've talked to Chris Joye on what he's thinking he's seeing in the market going forward. What's the IAMP Capital view on the property sector?
It's a hard one to pick at the moment. There are a lot of different factors kind of pulling prices up on one hand and down on the other. The last few weeks has seen a fall in Melbourne property prices, and it looks like they're down slightly for the month, whereas in Sydney prices are still up for the month of April. And the biggest reason for that, I think, is because Melbourne did have stricter restrictions around people who could inspect properties, whereas Sydney's ones were a bit looser. So these restrictions around inspections and auctions are definitely having a negative impact on property prices. These restrictions are likely to be eased in the near term because we're seeing, some easing in broad lockdown measures. That should be positive for property prices on the one hand. However, with a rising unemployment rate, it's difficult to see a lot of upside momentum for the property market in Australia for the next few months, I think.
Yeah, I think most people, accept that prices aren't going to rise, but they're pondering how deeply they might fall. And as the information changes around how long the closures and lockdowns might occur, be in place for, I can imagine you and your illustrious colleague Shane Oliver running back to your computers and reworking your predictions of how much the economy contracts by 2020 and how much it then rebounds by in 2021. And that's my next question. What are we going to contract by and what are we going to rebound by? And we want you to be 100% correct, Deanna.
Well, that would be difficult because we change our forecast pretty much on a daily basis at the moment, given all the numbers coming in. Look, for the next 2 quarters, the pace of growth will be exceptionally weak. Australia entered a recession in the March quarter with a small fall. In the US this week, for example, we saw that their GDP fell by about 1% over the quarter. I think in Australia we'll probably see a similar number for the March quarter. The June quarter will be a much larger fall. We're looking for a fall of about 10% over the quarter. So overall for the year, it's going to look pretty soft. In the September and December quarter, we should see a bit of a rebound, but growth for the year as a whole will probably fall by about 6% in Australia. And that's the largest fall that we would have seen since the Great Depression here.
Yeah.
In 2021, we should be supported by an increase in the money supply, lower interest rates, the RBA doing a lot of stimulus, of course, the fiscal stimulus that the government's done. I think the government's fiscal program is probably one of the best in the world in terms of its impact on the economy. However, we don't expect the actual level of GDP growth to get back to its pre-coronavirus level until sometime in 2022. So we're looking for a pretty soft recovery, even though if you look at it on a chart and you look at the growth rate, it will look like a V-shaped recovery. But that's how all recoveries will look once you've had such a deep downturn.
It's funny, I can't remember the economist's name, but it was one of the usual suspects that people like me, talk about or interview. I'm going to have to try and find it was. But there was one economist out there, you might have seen it as well, who suggested that we might not even have a technical recession, which would mean that the March quarter, I guess, is just a little bit positive because January and February were okay compared to March. And then the June quarter has to be a shocking negative. But then we get a little bit positive in September. Is that too way out to believe, Deanna?
It's possible because of the strength in retail sales. Would you believe that all the panic buying in March actually led to the biggest rise in retail sales that we've ever seen? Even
the toilet paper effect, saved by the toilet paper effect.
And hand sanitizer, paper towels, pasta. That panic buying led to the strongest rise ever, even more than all the purchases that people did before the GST came into effect. And that will add, a pretty decent chunk to consumer spending over the March quarter. However, I don't think it will be enough to offset the weakness that we're going to get in tourism. Remember that the travel ban from Chinese tourists started back in January, and we do rely a lot on Chinese tourist arrivals from a retail perspective, education arrivals as well. They would have all ceased, business travel. So I think that those negatives will still outpace some of the positives that you might get from all this panic buying. So I still think that we will have a technical recession. But it's interesting that you say that. I mean, for example, I don't think China will actually have a technical recession. They had a very negative March quarter, but they look like they're pretty much back at normal capacity now.
Yeah. I must admit, I do love that quote, what if the opposite is true? And it does cover so many things that people like you and I watch on a regular basis. Now, I want you to explain one thing before I get back into property, because I read one of Shane's notes, I think it was last week, we actually pointed out that the travel effect on GDP is actually a lot smaller than what people expect. And I guess part of the reason is that despite the fact we get a lot of travel dollars coming in, Australians are prolific travellers going out. And I think did he say 0.5% of GDP?
Yeah, that's right. So once you take into account the imports or Australians travelling overseas, the actual impact for net travel to Australia is to GDP is worth about 0.5 or 1% of GDP. So it's not huge, but you have to remember that consumer spending makes up about 65% of Australia's growth. So that's really the key driver here. But small changes in travel can still make the difference between a positive or a negative GDP print. So it will still make a difference. However, I suppose that the key point is that even if our borders are closed for 6 months, for 12 months, yes, our GDP growth won't be as strong as it would have been with all that travel. However, Australians will still be able to travel domestically. We might have open borders with New Zealand, so not all is lost. Yeah,
and that's right. The intra or interstate travel could make up, because we know all Australians are desperate to travel after being locked up. So the Gold Coast and the Sunshine Coast and the Port Douglas area may well experience some fantastic growth.
That's
right. Now, let's just extrapolate. When the government was talking about hibernating for 6 months, what kind of growth story were you expecting? And if that hibernation ends up only being 3 months, what would you adjust your forecast by? And I know it's a very easy question to be asked on the spot, but hell, you're the person who should be able to do it.
Look, I think the biggest impact will be a less negative June quarter because businesses will be some businesses will be back up and running around May, and you'll get maybe a month and a half of positive flows to the economy. So maybe we won't see such a large 10% fall like we're expecting in the June quarter.
Yep.
It might be a bit softer. I mean, it will still be a big negative, but it won't be as large. That's probably the biggest impact. And then, of course, maybe the rebound in September will be better as well, because you will see more business activity and economic growth.
Okay. Now, one thing we know is a big driver of house prices is unemployment, high and real unemployment. Now, the unemployment numbers we get this year aren't going to be real unemployment numbers, because JobKeeper will sort of cover it up a bit, I presume. Fill us in on that. But eventually, there will be a residue of unemployment from the businesses that have struggled. The businesses that actually have used the coronavirus to sort out its workforce, where they might have hung on to people during a boom, but now this has come, they'll reshape their workforce. What do you think the unemployment rate, the real rate, will be come, let's say the spring sale of houses? Where do you think it will be, and what might that be the impact on the spring property sales?
Yeah, I think that's a really important point that you make. JobKeeper will keep the unemployment rate artificially lower than probably where it could be, but a lot of those businesses might not survive the 6-month period when after the 6-month period when JobKeeper is going to be ceased. So we think the unemployment rate will end the year probably somewhere at around 8%, after a peak of about 10% in the next few months. 8% is still extremely high for Australia. That's equivalent to where it was around the GFC. We're at an unemployment rate at the moment of just over 5%. So it's a pretty big increase. There'll also be a big increase in underemployment, which is people that want to work more hours. So maybe full-time workers that have been shifted to part-time work, or casual workers who want more hours. That's still a drag on household incomes, and that's still important, even though it might not be evident in the unemployment rate. And I think that this drag to household incomes, because the unemployment rate will be much higher at 8%, that will really keep property price growth low. Even though you might not see continued falls in property prices, it's really difficult to see an environment in the next 12 months where you see sustained increases in property prices.
Yeah. Deanna, as always, it's great catching up with you, and thanks for your insights.
Thank you for having me.
Pleasure. Well, clearly the impact of the coronavirus on the property sector has implications for lots of the services businesses that operate in the sector. I'm talking to Tony Mangione, who's a long-term mate of mine, and he owns the Mangione Property Valuations and Consultancy. Tony, thanks for coming on the show.
Thanks for having me, Pete.
All right, so I know you say there's some really important dates that have come out of the coronavirus, but I would like to hit you with the first question. As a valuer, and you've been in the game a long time, have you ever had to encounter anything like this that clearly has a big impact on A, your business, but B, the valuations that are critically important for everybody who tries to get a loan, where the banks just want to know, what the valuation is, and also people even trying to work out what they should pay for a property?
Well, that's right, Pete, because I've never seen anything like this. I've seen 3 of them, which was in the 90s and the GFC. This one's a 2-pronged attack, whereby we're getting hit by the health issues as well as the economical issues. And basically, the API sat down with the banks and the insurers, and they sort of come up with some significant protocols to enable us to do valuations that we don't usually do, because, as you would be aware, a valuation starts off with a full inspection, whereby we actually go through the property and make our notes, measure up, etc., etc. Yeah. So with the government putting restrictions on auctions and open for inspections around the 25th of March, we had to rethink the way we were doing things. And some of those were full inspections or an external inspection, whereby we were given certain protocols whereby we didn't have to go into the property, where we can inspect the property based upon old reports, information by using FaceTime and those sorts of things. There's another one that the bigger companies have come up with, which is a virtual inspection, but it's not really accepted at the moment. So yes, there has been a big change, but basically we're adapting to it as best we can.
And Tony, does this mean, if it's possible, where you can come out and do the external valuation, link it to the calibre of the property on the outside compared to the rest of the neighbourhood, but then can you, say for example, get the owner of the property to do a video inspection so you get an idea of the calibre of the finishes and all that sort of stuff?
Yeah, so there are some apps that some of the big companies have developed whereby they can do a video link up. But from me, with a smaller business, FaceTime is probably just as good, where they can walk us around the house.
Yep.
And in some cases, some of the banks want a GPS reading. All the photos that we take all have to have a date imprint on the photo, so it's in the report. So basically, they can walk us around the property. So yeah, it's something that we can use, because the hardest thing, if you're looking outside and you can't see inside, you then can't do a comparison to the evidence that you're going to be looking at to come up with a figure for the valuation.
Yeah.
And I just seem to think this is a short-term fix until such time, because there are certain things that when a valuer takes an instruction to do a valuation, we have a questionnaire that we send out to the client to make sure that it's safe for us, and us acknowledging to them that we're safe to enter the site. And when we get to these sites, we prefer if all the doors are open, lights are on, and the client can step outside, we can go and do the valuation. They can step back inside, then we can do the rest of the valuation, like measuring up, etc. So it's got us around the issues of the restrictions that the government's put on us, but those restrictions seem to be starting to become a bit more relaxed in the last couple of days that we've seen.
Yeah, and then that would make you much more comfortable. Tony, can you give us an idea? Look, and this may well have happened in the recent weeks or so, whereby you know of a property of a certain value, and you've been asked to revalue it again since the coronavirus, and are you able to say what the change in value of the property is? I know it's a big ask, but hell, I've got to ask you anyway. Because a lot of people out there are wondering what kind of valuation effect the coronavirus has had on a typical, Sydney property which you'd be valuing.
That's a very interesting question, and a good question, Pete, because at present I'm doing a portfolio of properties for a non-profit organisation, which I did in 2017. Yep. And naturally 2017 was the very top of the market in November 2017. And then we saw this flatline effect. And so any properties valued from that point in time, there was I'm finding at the moment, there's sort of like a reduction in the property. The problem the valuers have at the moment is that there's less amount of transactions happening. And the other thing that we're finding is that because that the auction results aren't being posted in the public arena, we have to wait for these transactions to hit RP data, which could be something up to 3 and 4 weeks' time. So the valuer has to have a good rapport with the agents to be able to find out what the properties might be selling for, because the banks want evidence that is less than 6 months old, and also we have to be able to we can use unsettled sales, but they're not confirmed. So it's very hard. There's a lack of information out there, and transactions are slowing up. But look, it's still moving. And look, before this coronavirus actually hit us, the market was starting to move, and I was seeing in February we were seeing this sort of thing, the fear of missing out was happening. And also there was a lot of people that had sold their properties looking to buy properties. So there was a bit of a surge there. But things I have hearing from agencies that the listings have dropped off, but the inquiry is up in the eastern suburbs, I heard the other day through one of my close colleagues at Ray White at Double Bay. So it's interesting what's going on.
Yeah, and I guess the big challenge for you is you got relationships with lots of businesses like banks and real estate agents and whatever, and your valuations, if they're really way out and wrong, it's not good for your reputation, But at the moment, you really don't know what's going on in this really unusual market.
Correct. And what the Institute have come up with, and not so much the Institute, but our insurers, because what took a long time for us as valuers to get endorsements now, we've got these endorsements that need to go into the valuations. And one of those endorsements is a thing called market uncertainty, whereby the macroeconomics of the COVID-19 outbreak have sort of basically disrupted the market sector. So as you would be aware, there is a market value definition, willing buyer, willing seller, which is Spencer versus the Commonwealth. In some respects, that market value doesn't really apply in this COVID-19. So we have to sort of make a judgment decision, and I think it would be brave of any valuer trying to adjust a figure of the sales downwards. But a lot of them would be in the back of their mind having a conservative effect on the value, just like properties that might be coming up that were off the plan sales about a year ago, whereby, those figures would be lower as well. So it's a challenging time for valuers, and it's nothing more the same than the other types of downturns we've had. But this is a two-pronged attack, Peter, and it's really, really... and the big key to this is, I believe, is that how long will we be in these restrictions? The faster we come out of it, the more the markets are less going to be affected. And by the fact that once these restrictions come off and the stimulus packages stop, I don't know whether there's going to be a further downfall in the market.
Yeah, it's going to be very interesting to see. And ultimately, you're going to learn more at the coalface than you are in speculation. But let me just put you on the spot. One of our old colleagues from our beloved North Bondi Surf Club come to you and say, Tone, you're an expert. I've got a place in Bondi. It was worth $3 million a year ago. What do you reckon is going to be my worst case scenario if I go to auction this weekend?
Well, given that, I would do the same as I would do for any valuation. I would start by trying to do the inspection, unless I'd done the valuation in previously, and also then take a look at what the market does. And in any type of downfall in market, rather than relying on the data that's coming from, say, RP Data, Price Finder, or any records out there, the valuer has to sort of look at the most current information. And that's where I said before, we have to sort of talk to the agents and see what's going on. The other thing that's becoming longer is the days on market, which is a very good indicator of the way properties are selling. And I could say to him that possibly it could be steady, but there might be a 5 to 10% discount, which might apply. Look, and I've always said that it's going to be very hard to make a call in regards to that because of the less transactions and the data. Trying to compare the data from the last time to now, because last time we had auctions and we had opens for inspections. Now we don't have that.
And Tone, over the years, we've done a lot of property transactions and whatever. I've always thought one of the strongest indicators of whether we're going to do well at an auction is how many contracts are taken out before the auction. How reliable is that? If you have to look at all the indicators out there that makes you feel comfortable about doing an auction, which one is the one that makes you think that this property is going to sell?
Well, the first reason why you would put a property to auction is because it's got some unusual characteristic about it, and that's the first thing. If it doesn't have that, it's just a normal run-of-the-mill property, there's a tendency not to take the property to auction, and generally that would happen in the eastern suburbs and those types of properties. And the amount of contracts is probably important. In the better times, the contracts were flowing quite readily. But at the moment, from what I'm hearing, and this is what I'm hearing about the virtual auctions, that a lot of people aren't accepting that. I at the moment are trying to list. I haven't watched one yet. There's an app called Auction Now, which the Cooley auctions have come up with. I'm going to try and view one over the weekend or shortly to see what happens. But what I'm hearing from that is that people are plugging into this, but they're just sitting on their hands. They're not trusting what's going on. So there's there's not that atmosphere, and they want the restrictions to be lifted as soon as possible. So it's not the same where in an auction room where an agent can go up to the person and sort of talk to them face to face.
Yeah. Okay, mate. So what's the message you would give to people out there? You know, you're a person who's been in the valuing game for a long time. What's the key message you'd like to leave for someone out there who's either going to be a seller or a buyer of property over the next month or two?
Well, my thoughts are, if the people that are selling at the moment are the people that have to sell, and that's shown by the amount of listings that were coming onto the market. I believe that, you know, we're in a holding pattern at the moment, and generally what I believe is that the months of June, July are usually the slower months within the property circles, and therefore, you know, hopefully that this winter month is a mild winter for our sake, for the health concerns of COVID-19, and as well the auction results. I believe if you want to put your property on the market, and look, you buy and sell in the same market, so it's not really going to affect. I'm going to make a statement here that I've been asked a dozen times a day, what do you think the effect's going to be? I don't think it's going to be as big as some of those commentators are saying, 30%. It could be anywhere between 7 to 10% downfall in the market, but we can't establish that until we've got some real clear data. So look, if you want to sell your property, I believe it's okay. But, you know, if you want to hire the services of a valuer, and that's become an idea that, you know, we've got the buyer's agents out there who I'm in close contact with some buying agents, and they still believe that the market's, you know, steady as it goes at the moment.
Tony, thanks for joining us.
Thanks very much, Peter, and stay well and safe. Thank you.
Cheers, mate.